Welcome to my channel. I'm going to show you step by step how to value a stock. We will enter the company's financial information and capital structure into my Excel model. Then we determine whether the stock is a buy or a sell. At the end, we calculate and analyze the financial ratios. I am doing this with you throughout the entire video, so it's like we're doing it together. I also answer every single comment, so please ask a question or let me know what you think. The stock we're going to look at is Sturm, Ruger & Company. Ruger is America's largest firearm manufacturer. Let's get started with the model. This company has a market cap of $1.4 billion. So that's the value of the company according to the stock market. Let's see what they're trading at, $77.83 a share. And the way you value a company is you estimate the future free cash flows and then you discount that number back to today's value. And that's what we're doing in this video. Now I'm pulling the actual free cash flow. And free cash flow is cash flow from operations minus capital expenditures. And now I'm going to pull the net income, which is the profit and loss on the income statement. And there's non-cash items on net income, like depreciation. Also, I'm going to pull the revenue, which are the sales for the business. And let's look at the numbers. So they have consistent positive free cash flow and net income every year, which is good. Let's look at a capital structure. They have no debt, which is amazing. So let's get the beta so we can figure out the cost of equity. The beta is how volatile the stock is. Really low beta, so if you're looking to hedge yourself against the market, this seems like a good stock, a 0.40 beta. Let's get the current assets. We need this to calculate the current ratio later. And current assets are the assets that can be liquidated into cash within 12 months. That's $249 million. And that's $164 million of cash, $52 million of receivables, and $28 million of inventory. Let's get their current liabilities at $61 million. And let's see what that is. $8 million of accounts payable, $1.2 million of taxes payable, $10.7 million of accrued liabilities, $9.6 million of deferred revenues, and $735,000 of other. Stockholders' equity, that's $24 million of common stock, $368 million of retained earnings. Let's get their operating income. That's $39 million. Let's look at a capital structure. They're 100% equity. Cost of equity is 5.39%, and that's the discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4. That's $1.2 billion. We discounted these numbers back to today using the weighted average cost of capital. That's down here in green. We get a value of the company of $1.1 billion. We divide that by 18 million shares, and we get an intrinsic stock price of $60. They're trading at $78, so they're trading at a 29% premium. So it's a sell according to the model. Let's see what Simply Wall Street says. They're at $87, so they're saying the stock is undervalued and it's a buy. Let's see where the stock has been trading at. So it seems like it's almost at its all-time high, and coronavirus has only helped this stock. I guess firearms are in more demand now. Let's look at the financial ratios. A bad PE, a weak price to sales, and a weak price to book. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. I like to see below 15, they're at 43. So investors are paying $43 for $1 of net income. Price to sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. They're at 3.4. I like to see below 2.5. So investors are paying $3.40 for $1 of revenue. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. I like to see below 3.5. They're at 5. So investors are paying $5 for $1 of book value. A high current ratio and a low ROE. So current ratio is current assets over current liabilities, so they can easily cover their current liabilities. They have almost too much current assets. ROE is net income over equity. I like to see above 20%. They're at 11%, so they don't provide the best value to the equity holders. The best way to look at ratios is to compare them to companies in the same industry. I've done videos on Boeing, BWX Technologies, CAE, Airbus, FTG, General Dynamics, Raytheon, and Spirit Aerosystems, all in the same industry as Ruger. And if Ruger has a ratio in red, they're worse than the average. If they're in green, they're better than the average. So they're worse in PE, price to sales, and price to book. They have the highest current ratio. They're weak in ROE. They're the only company with no debt, so that's really good to see. And they're much smaller than the average. The average is $29 billion. They're at $1.4 billion. So this is the type of company that's probably going to always be needed, guns. So let me know what you think of the video. Leave a comment. I answer all comments. Thanks for watching.